7 Harsh Truths Men Over 50 Learn Too Late. Part 1. The Invisible Wall of the 51st Year. Imagine a stickman named Joe. Joe has just turned 51 years old in the year 2026. For 3 decades, Joe followed the success script perfectly. He worked long hours, climbed the corporate ladder, and contributed to his traditional 401k. He believed that by the time he reached his 50s, he would be entering the victory lap of his career, a period of high earnings and maximum professional respect. But as Joe performs a forensic audit of his surroundings, he realizes he has hit an invisible wall. The world of 2026 is not the world he was promised. He is staring at a labor market gripped by the big freeze and a tax code designed to harvest the very success he worked so hard to achieve. The first harsh truth Joe learns, and he learns it too late, is that experience is no longer a shield. It is a target. In our surgery on the 2026 labor market, we see that the age pay gap, the difference in earnings between workers under 35 and those over 55, has widened by more than 60%. While Joe thought his seniority made him unreplaceable, the system sees him as a high-cost resource. As agentic AI moves from simple task execution to workflow automation, companies like ServiceNow and Salesforce are realizing they can get more output from a single junior supervisor managing a fleet of AI agents than from a team of 10 senior managers like Joe. Joe looks at the Williams Group study and feels a cold chill. 70% of wealthy families lose their wealth by the second generation, usually because they have money but no architecture to protect it from the divergent forces of the modern economy. Joe is realizing that his 50s will not be a victory lap. They will be a forensic battle for sovereignty. He is trapped between the big freeze of hiring and the fiscal drag of a government that has frozen tax thresholds until 2031. Today we are opening the file on the decade of truth. We are going to look at the 7 mathematical and psychological traps that men over 50 ignore until the damage is irreversible. We will analyze the RMD Tax Trap, the digital inheritance wall, and why the success tax of the One Big Beautiful Bill Act is specifically designed to harvest Joe's generation. Part 2. The Joint Venture and the Algorithmic Target, Truths 1 and 2. Joe looks at his traditional 401k balance and sees a number that makes him feel secure. But our forensic audit reveals the first harsh truth that men over 50 often ignore until it is too late. Your retirement account is not your vault. It is a joint venture with the government, and the government is a senior partner. Truth number 1. The RMD Tax Trap. Joe has spent 30 years deferring his taxes. He thought he was being smart. But in the year 2026, under the One Big Beautiful Bill Act, OBBBA, the rules of the game have shifted. Joe is approaching the required minimum distribution, RMD, wall. By the time Joe hits age 73 or 75, the system will force him to take distributions from his traditional accounts. Because tax brackets like the 32 and 35% marks are now permanent and subject to fiscal drag, Joe's savings will be harvested at a much higher rate than he anticipated. Even worse, his modified adjusted gross income, MAGI, from these forced distributions will trigger the OBBBA phase-out traps. His $6,000 senior bonus deduction will vanish at a rate of 6% for every dollar over the threshold, effectively turning his golden years into a forensic battle against a 60% marginal tax rate. Truth number 2. The $50,000 nervous threshold. Joe finally has $50,000 sitting in a standard savings account. He feels like a king. But our audit of banking algorithms reveals a different reality. Banks get nervous when you have $50,000 saved. Why? Because at $50,000, you cease to be a harvestable resource that needs small loans and high-interest credit. You move into the exit velocity zone. The bank's high-engagement algorithms begin to flag you. They know that if you move that $50,000 into a digital anchor, like 0.1 Bitcoin or a high-yield bridge account, they lose their ability to use your deposits to fund their own expansion. Joe learns too late that the bank is not his friend. It is a weight designed to keep him between $0 and $5,000.
where his financial ignorance generates $38 billion in annual fees for the system. Part 3. The Big Freeze and the Healthcare Wall. Truths 3 and 4. As Joe navigates his 50s, he encounters two more structural forces that his younger self never saw coming.
Truth number 3. Experience is a target, not a shield. Joe believed that his 25 years of industry experience made him unreplaceable. Our forensic audit of the 2026 labor market proves him wrong. We are witnessing the Big Freeze. Large corporations are using agentic AI to move from task execution to workflow automation. They are freezing entry-level hiring and using the natural 13% annual attrition rate to shrink their headcount without triggering layoffs. Joe discovers that he is caught in the age pay gap. In the United States, the earnings difference between workers under 35 and those over 55 has widened by more than 60%. To the algorithm, Joe is a high-cost legacy asset. If Joe hasn't reskilled as a systemic supervisor of the AI that replaced his juniors, he is the first one to be quietly demoted or optimized out of the ledger. Truth number 4. The invisible healthcare surcharge. The final truth Joe learns in this block is that healthcare in your 50s is a second mortgage. Joe sees that the family HSA contribution limit has risen to $8,750 for 2026. He thought this was a nice benefit. Our surgery on retirement math shows it is a survival requirement. Experts now predict that the average couple will need hundreds of thousands of dollars just to cover medical expenses in retirement. Joe realizes too late that every dollar he didn't put into his HSA in his 40s is a dollar he must now harvest from his 401k, triggering the very taxes and phase-outs he was trying to avoid. Joe is learning that in the 2026 economy, you don't retire to a beach, you retire to a sovereignty fortress. And if you didn't build the walls in your 40s, the wind in your 50s is going to be very, very cold. Part 4. The generational leak and the housing prison. Truths 5 and 6. Joe is now looking beyond his own ledger and toward the legacy he hopes to leave. But as he turns 51 in the year 2026, he encounters two of the most emotionally charged traps in the success script. Truth number 5. The generational leak is mathematical, not accidental. Joe has heard the headlines about the great wealth transfer. According to report data from Cerulli Associates and Vanguard, over $84 trillion in assets is expected to be inherited by younger generations by 2045. Joe assumes this will be his family's safety net. However, our forensic audit reveals a devastating statistic from the Williams Group. Roughly 70% of wealthy families lose their wealth by the second generation. Joe learns too late that having money is not the same as having a sovereign architecture. In the year 2026, the leak is worsened by the digital inheritance wall. Joe has significant wealth in online investment portals and cryptocurrency, but he hasn't followed the revised Uniform Fiduciary Access to Digital Assets Act, RUFADAA, hierarchy. Without explicit platform-level legacy designations or a technically competent digital executor, his family may find themselves legally locked out of their own inheritance by restrictive terms of service. Joe realizes that without a trust model for his digital wealth, his legacy is just one forgotten password away from permanent deletion. Truth number 6. Your forever home is a wealth prison. For decades, Joe was told that his home was his best investment. But in the 2026 economy, where housing in major hubs costs 15 times the average household income, his massive suburban house has become a physical anchor. As Joe performs a surgery on his carry cost, he sees that his forever home is harvesting his liquidity exactly when he needs it for his bridge account strategy. Between property taxes, subject to fiscal drag, rising maintenance, and the poverty premium on insurance for deprived or high-risk postcodes, Joe's home is a wealth prison that freezes his capital and limits his strategic immobility. He learns too late that in a K-shaped economy, a paid-off mortgage is a victory, but a high-maintenance mansion is a liability that prevents him from crossing the invisible bridge to sovereignty. Part 5. The Forensic Verdict and the Sovereignty Exit. Truth 7. Joe has reached the end of his audit.
He is standing at the summit of his 50s, looking back at a career of task execution and forward to a future of systemic supervision. Truth number 7. Income is a resource, but sovereignty is the only asset. The final harsh truth is that a high salary, even the $178,000 mark Joe worked so hard to reach, is just a crop for the system to harvest. Real wealth in 2026 is not defined by how much you earn, but by low burn and high optionality.
Joe realizes that the only way to win the game is to stop playing for status and start playing for exit velocity. He implements the final stages of the positioning protocol, funding the bridge account. Joe stops over-contributing to his government-partnered 401k and prioritizes a taxable brokerage account. This is his bridge that allows him to retire at 55 using the rule of 55 rather than waiting for the 65 wall. Securing the hard deck. To protect his wealth from the 3% annual currency devaluation, Joe secures 0.1 Bitcoin in cold storage. This 0.1 represents a fixed percentage of the global ledger, 38 times the global fair share, that is immune to bank nervousness and OBBBA phase-out traps. Neutralizing the poverty premium. Joe uses his $20,000 silent alarm buffer to stop the 1,000 small bites of the system, instantly increasing his real take-home pay by avoiding monthly surcharges and prepayment traps. The sign-off. Joe is no longer the stickman who learns too late. He is the stickman who performed the audit in time. The decade between 50 and 60 is not a victory lap. It is a forensic battle to determine who owns your future, you or the algorithm. Don't wait until the RMD wall hits you at 73. Don't wait until the big freeze makes your experience a target. Build your bridge, secure your anchor, and disappear into sovereignty. If this forensic audit of the harsh truths of 50 changed how you see your retirement plan, hit that subscribe button. We are dissecting the hidden equations of the 2026 economy every week to help you stop being the crop and start being the owner. I'm Joe from fin.stickman, and I will see you in the next one.